Hi, I'm Baldwin Burgess, and welcome to the second episode of the Real Assets Investing series. In today's episode, we again have Peter Pavlov, the portfolio manager of the Sustainable Real Assets Fund. This strategy provides investors with an actively managed allocation to 7 key themes that are set to benefit from unprecedented growth in global demand and could also help investors protect themselves against the threat of rising inflation. In this second episode, Peter and I discuss gold. It's a key component within the Sustainable Real Asset strategy. And you may have seen our article in the beginning of October where we discussed the outlook for gold. At the time, we saw an interesting development where market traders had been increasing short positions, while, in contrast, the gold merchants were holding their inventories more unhedged than we had seen in a while. It could explain part of the rally during the first 2 weeks of the month, and even after a bit of a pullback, the upward trend seems to have continued. Now, during the next few minutes, Peter is going to tell us more about the fundamentals that are driving this market to better understand where gold and the opportunities that make up its value chain will be heading in the near term. So Peter, it seems like gold has been shining again after a mostly downward trend during 2018. What is on your mind these days when you think about investing in gold?
Morning, Baldwin. Yes, you're correct. Gold is shining again. Since the beginning of the quarter, gold prices are up more than almost 5% in US dollar terms. Gold stocks are up more than 12% and are outperforming almost every other equity market in the world. It has been a difficult quarter. And the reason of that outperformance can be found in at least 3 different areas. First of all, we had a global risk-off environment that is taking place. We also started the quarter with a very extreme positioning, especially when it comes to gold futures. And then finally, we can also talk about less competition from other traditional asset classes. First of all, at the beginning of the quarter, there was a situation when interest rates were really elevated and investors started to reprice their growth perspective in that new environment, and in some cases even extrapolated the pace of increase in interest rates. That led to a significant underperformance in growth stocks and in cyclical stocks as well. Cyclicals were also hit, but ongoing trade war concerns and more importantly, by the fact that investors now are pricing a synchronized global growth slowdown. In that kind of environment, traditional safe havens are attracting more inflows, and actually US 10-year, German 10-year, and gold have attracted massive inflows during that period. In terms of positioning, when we started the quarter, many managers were overly bearish in the gold on gold prospects, and it came after a period of 7 consecutive months of negative returns for gold price. Many managers at the beginning of the quarter have been running a net short position on aggregate, and net shorts have never been so high over the past 4 years. At the same time, commercials, they almost unloaded all of their hedge book, and net commercials positions was actually positive. It started to revert back to normal, and it led to increased volatility, intraday volatility in gold prices, and also to some outsized moves. And as a result, gold outperformed other precious metals and commodities, but also the other asset classes. When you speak for competition, we can talk first of all about Bitcoin, which was 1 year ago being seen as a serious competitor to gold, especially as an alternative currency. Bitcoin is negative for the year, and it is no longer considered as a mean of diversifying an investor portfolio. The second very important fact is that the Fed funds futures market is no longer pricing any additional increase in Fed funds. There is only one increase that is being priced for the next 12 months that will eventually lead to 2.5% of US money market rates. Then at the beginning of the year we had very negative sentiment towards the US dollar, and as usual actually it did well. The US dollar appreciated both against developed market currencies and also against emerging market currencies. But the tailwinds that the US dollar benefited from during that period are almost all behind us. And going forward, as positioning is overstretched and eventually there will be less increases than initially anticipated, one could argue that those tailwinds are going to fade, and over the next couple of months we will probably see stabilization, if not a weakening of the US dollar against major developed and emerging market currencies. When we talk about the outlook, we could focus on fundamentals and then also on the technical picture. Fundamentals, I would say that they do not favor a prolonged period of distress for gold prices. Actually, production is close to peak level, and as we know, we have very little sources of supply for the gold market, and production has been reaching a plateau over the past several years, and this is the result of underinvestment by gold mining companies during the previous market crash. Then central banks that 10 years ago used to be a provider for the gold market, now they have been buying steadily and then continue to buy. We are seeing an increasing number of central banks coming to the market and diversifying their reserves. Then we have the US 10-year that started to decline recently as a result of declining CPI. And that CPI has been declining for a very simple reason, and that reason being that people especially inflation and expectations have been hit by people extrapolating what happened in recent years to wages and also to tariffs that has been put in place by different administrations. Again, we have less competition from other safe haven asset classes, and because the number of those asset classes is basically being reduced. Finally, it is really difficult to increase gold production, and if we want to balance the market as we speak, gold miners, they need to go into lower grade ore, and that will lead to an increase in their all-in producing cost. At the same time, recycling, which is another source, is not really picking up at those prices. Probably could see another wave of recycling at high levels. If we are to make a forecast on gold prices, short-term technical picture could be challenging because these gold prices are close to a very important resistance level, close to $1,260 per ounce, and gold have been stabilizing there over the recent days, and eventually it could be difficult for gold prices to overcome that obstacle. Medium term, we have a lot of upside targets, and we could see gold prices at $1,300 or even $1,400 per ounce in the coming months. Gold is behaving as the traditional asset class for decorrelation and for safe haven. It is basically the insurance policy or within a portfolio, and it could benefit not only from rising or stability in inflation anticipation and expectations, but also from fear that other risky asset classes will eventually continue to do badly. Those fears in the short term could be seen as a bit of as if the market is overreacting, but medium term there is a fundamental change in market sentiment, and that market sentiment could eventually turn in favor of gold.
Thanks for your time, Peter, and for sharing your insights with us.
Thank you very much.
And thank you very much for taking the time to listen to this episode. To make sure not to miss other episodes of the Real Assets Investing series, please go to silkinvest.com and subscribe to our list at the bottom of the site. That way we can keep you updated of new episodes as they come out. So thanks again for your attention, and until very soon.